This content is for educational purposes only and is not financial advice. Consult a qualified advisor before investing. Welcome back to Understanding Money. Today, we're diving into the world of cryptocurrency, a topic that generates both wild excitement and serious skepticism. Whether you've heard friends talking about Bitcoin millionaires or you're wondering if crypto is just digital monopoly money, this guide will give you the honest, balanced perspective you need. By the end of this video, you'll understand what cryptocurrency actually is, how it works, the opportunities and risks involved, and most importantly, how to approach crypto investing safely and intelligently. So, let's cut through the hype and get to the facts. 1. What is cryptocurrency, really? Let's start simple. Cryptocurrency is digital money that exists only online, no physical coins or bills. But it's more than just numbers in a bank account. Crypto is built on something called blockchain technology, which is like a digital ledger that tracks every transaction ever made with that currency. Think of it this way. Imagine if every dollar bill had a complete history written on it, showing everyone who ever owned it. That's essentially what blockchain does for digital coins. It creates a permanent, unchangeable record of ownership. The crypto part comes from cryptography, complex mathematical codes that secure these transactions. It's designed to be nearly impossible to counterfeit or double spend. Key differences from traditional money. No central bank or government controls it. Transactions are recorded on a public ledger. It's global, works the same everywhere. Transfers can happen 24/7, not just during banking hours. Transaction fees are often lower, though not always. 2. A brief history. From pizza to mainstream. Bitcoin was created in 2009 by someone using the name Satoshi Nakamoto, whose real identity remains a mystery. The first real-world Bitcoin transaction? 2 pizzas for 10,000 Bitcoin in 2010. Those same Bitcoin would be worth hundreds of millions today. For years, crypto was mainly used by tech enthusiasts and, unfortunately, some illegal activities. But gradually, legitimate businesses started accepting it. Now we have major companies like Tesla and MicroStrategy holding Bitcoin, PayPal and Visa, processing crypto payments, countries like El Salvador making Bitcoin legal tender, traditional banks offering crypto services. This evolution from fringe experiment to mainstream financial tool is part of what makes crypto so interesting and so volatile. 3. Major cryptocurrencies explained. While there are thousands of cryptocurrencies, let's focus on the big players, Bitcoin, BTC. The original and largest by market value. Often called digital gold because many people buy it as a store of value. Bitcoin is designed to be scarce, only 21 million will ever exist. Ethereum, ETH. More than just a currency, it's a platform for smart contracts and decentralized applications. Think of it as the foundation for a new kind of internet where no single company controls everything. Other notable mentions. Stablecoins like USDC, Tether, designed to match the value of traditional currencies. Cardano, Solana, Polygon. Alternative platforms trying to improve on Ethereum. Binance Coin, used on the world's largest crypto exchange. Each serves different purposes, but Bitcoin and Ethereum dominate the market. 4. How cryptocurrency works. Let's break down the technology without getting too technical. Blockchain, the digital ledger. Imagine a notebook that's copied to thousands of computers worldwide. Every time someone makes a transaction, it gets written in all the notebooks simultaneously. To change a record, you'd need to change it in most of the notebooks at once, which is virtually impossible. Mining and validation. People called miners use powerful computers to verify transactions and add them to the blockchain. They get rewarded with new cryptocurrency for this work. It's like being paid to be a bank auditor. Public and private keys. Your crypto wallet has 2 keys. A public one, like your address that people can send money to, and a private one, like your password that lets you spend. Never share your private key. It's like giving someone your bank PIN. Decentralization. No single entity controls the network. It's run by thousands of computers worldwide, making it resistant to shutdown or manipulation. 5. Why people invest in cryptocurrency. Potential for high returns. Crypto has produced some spectacular gains. Bitcoin went from pennies to tens of thousands of dollars. Early Ethereum investors saw similar returns. Of course, past performance doesn't guarantee future results. Portfolio diversification. Crypto often moves independently of stocks and bonds, potentially providing diversification benefits. Inflation's hedge. Some investors view Bitcoin as digital gold, a hedge against currency debasement and inflation. Technology bet. Investing in crypto is partly betting that blockchain technology will reshape finance, just like the internet reshaped communication. Global accessibility. Crypto works the same everywhere, potentially providing financial services to underbanked populations. FOMO, fear of missing out. Let's be honest. Some people invest because they're afraid of missing the next big rally. 6. The risks. Let's get real. Extreme volatility. Crypto prices can swing 20-50% in a single day. Bitcoin has crashed 80% plus multiple times in its history. Your investment can literally halve overnight. Regulatory uncertainty. Governments are still figuring out how to regulate crypto. New rules could dramatically impact prices and usability. Technical risks. Lost private keys mean lost coins forever. No customer service to call. Exchange hacks can result in total loss. Smart contract bugs can drain funds. Market manipulation. Crypto markets are less regulated than traditional markets, making them susceptible to manipulation by large players. Lack of intrinsic value. Unlike stocks, which represent company ownership, or real estate, physical property, crypto's value is largely based on what others are willing to pay for it. Environmental concerns. Some cryptocurrencies, particularly Bitcoin, use enormous amounts of energy for mining. 7. How to approach crypto investing safely. Start small, really small. Most financial advisors suggest keeping crypto to 5 to 10% of your portfolio maximum. Start with money you can afford to lose completely. Do your research. Understand what you're buying. What problem does this cryptocurrency solve? Who's behind it? How does it work? Use reputable exchanges. Stick to well-known, regulated exchanges like Coinbase, Kraken, or Binance. Avoid obscure platforms. Secure your investments. Use strong, unique passwords. Enable two-factor authentication. Consider a hardware wallet for large amounts. Never share your private keys. Dollar cost average. Instead of trying to time the market, invest small amounts regularly. This helps smooth out the volatility. Have an exit strategy. Decide ahead of time when you might sell, either to take profits or cut losses. 8. Common crypto mistakes to avoid. FOMO buying. Jumping in during a rally because everyone's talking about it. Usually leads to buying high and selling low. Falling for scams. If someone promises guaranteed returns or asks for your private keys, run. There are no get-rich-quick schemes. Putting everything in one coin. Even within crypto, diversification matters. Don't put all your crypto money in a single coin. Emotional trading, making decisions based on fear or greed rather than logic and strategy. Ignoring taxes. Crypto transactions are taxable events in most countries. Keep good records. Investing more than you can afford. This should go without saying, but crypto is speculative. Never invest money you need for essentials. 9. Tax implications and legal considerations. Tax treatment. In most countries, cryptocurrency is treated as property for tax purposes. This means buying and holding isn't taxable. Selling for profit creates capital gains. Trading one crypto for another is a taxable event. Using crypto to buy goods is a taxable event. Record keeping. Track every transaction. When you bought, sold, the amounts, and the values in your local currency. Tax software like CoinTracker or TaxBit can help. Legal status. Check your local laws. While most countries allow crypto investing, some have restrictions or outright bans. 10. The future of cryptocurrency. Growing adoption. More companies are accepting crypto payments, and traditional financial institutions are offering crypto services. Central bank, digital currencies, CBDCs. Many governments are developing their own digital currencies, which could impact the crypto landscape. Improved technology. Newer blockchains are addressing issues like energy consumption and transaction speed. Regulatory clarity. As regulations become clearer, institutional adoption may accelerate. Integration with traditional finance. Crypto is increasingly being integrated with traditional banking and investment services. Web3 and DeFi. Decentralized finance applications built on blockchain could reshape how we think about banking, lending, and investing. 11. Building your crypto knowledge. Reliable information sources. CoinGecko and CoinMarketCap for price data and market information, the official websites and white papers of projects you're interested in. Established financial news sources with crypto coverage. Avoid social media for investment advice. Too much hype and misinformation. Continue learning. The crypto space evolves rapidly. Stay informed about technological developments, regulatory changes, and market trends. Join communities. Engage with crypto communities, but maintain a healthy skepticism. Remember, many people have financial incentives to promote certain projects. 12. Sample crypto allocation strategies. Ultra-conservative, 1-2% of portfolio. 7% Bitcoin, 30% Ethereum. Focus on the most established cryptocurrencies. Moderate, 5% of portfolio. 50% Bitcoin, 30% Ethereum, 20% other top 10 cryptocurrencies. Include some diversification while staying with established players. Aggressive, 10% of portfolio. 40% Bitcoin, 30% Ethereum, 20% other established cryptos, 10% smaller speculative plays. Higher risk, higher potential reward. Remember, these are just examples. Your allocation should depend on your risk tolerance and overall financial situation. 13. When not to invest in crypto, you can't afford to lose it. If you need this money for rent, groceries, or other essentials, don't invest in crypto. You're looking for guaranteed returns. Crypto is highly speculative. There are no guarantees. You don't understand it, never invest in something you don't understand, especially something as complex as cryptocurrency. You're overwhelmed by volatility. If seeing your investment drop 50% would keep you awake at night, crypto isn't for you. You're near retirement. If you're close to needing your money, the volatility risk may be too high. 14. Your crypto action plan. Educate yourself further. Read white papers, understand the technology, learn about the projects you're considering. Start with established players. Begin with Bitcoin and Ethereum before exploring smaller cryptocurrencies. Choose a reputable exchange, research exchanges, check their security history, and understand their fees. Start small, begin with a tiny allocation, maybe 1-2% of your investment portfolio. Set up security, use strong passwords, enable two-factor authentication, consider a hardware wallet. Create a strategy, decide your allocation, investment timeline, and exit strategy before you invest. Track everything. Keep detailed records for tax purposes and portfolio management. Stay informed, follow developments in the space, but avoid making emotional decisions based on daily news. Conclusion: crypto's place in your financial journey. Cryptocurrency represents both tremendous opportunity and significant risk. It's a fascinating technology that could reshape finance, but it's also highly speculative and volatile. For most people, crypto should be a small part of a well-diversified portfolio, if it's part of your portfolio at all. Focus first on building your emergency fund, maximizing employer 401k matches, and establishing a solid foundation with index funds and traditional investments. If you do decide to explore crypto, approach it with the same discipline you'd apply to any investment. Do your research, start small, invest only what you can afford to lose, and maintain a long-term perspective. The crypto space moves fast, but building wealth still requires patience, discipline, and sound financial principles. Don't let the excitement of potential quick gains distract you from the basics of good investing. What questions do you have about cryptocurrency? Have you invested in crypto, and what has your experience been? Share your thoughts in the comments below, and if this guide helped clarify crypto for you, please like and subscribe for more balanced, practical financial education. Cryptocurrency investing is highly speculative and risky. Always do your own research and consult with qualified financial professionals before making investment decisions. Never invest more than you can afford to lose. Thanks for watching. And remember, whether you choose to invest in crypto or not, the most important thing is building a solid financial foundation that aligns with your goals and risk tolerance. Disclaimer: this video is for educational purposes only and does not constitute financial advice.